Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Constance Hunter joins us right now. Thrilled that she could be with us today. Constance, I look at where we are, and boy, does it reaffirm, I'm going to call it Wallerian rate cuts. Are we now generating rate cuts into the first quarter of next year?
Well, I think I said in my note to you that whatever we see in today's CPI is not going to reflect what's coming down the pike, right? We have seen companies absorb a lot of the tariffs because there's so much uncertainty. And why would you pass on tariffs if you think that they're going to be removed or negotiated lower? You're just going to impair your market share and impair your brand. And I think that is about to come to an end. And we're going to see that in future CPI reports. With that said, the Fed is going to cut next week, and this certainly gives them cover for next week and possibly even to cut again in December.
Are we anywhere near the territory of a 50 basis point rate cut?
Ooh.
We have a dearth of data. But I mean, come on, if we were, just to make it up, folks, it's Friday, help me here, folks. If we made it up, Constance, and we said we got a 57,000 non-farm payroll, and then maybe next month we get a 42,000 non-farm payroll, I mean, come on, they got to get it going, don't they?
Well, it's interesting, and I'm actually sitting here in Michigan, where close to GM, where you mentioned those layoffs.
Yeah.
And certainly if you look at a state like Michigan, it's got a higher rate of unemployment than the rest of the country. It's definitely suffering. And it has been our view that the Fed is going to look at labor markets more than inflation because they're going to look through that CPI increase that we do eventually expect from tariffs.
Paul,
as I say, the private data suggests that the job market is weakening as well, right? In the absence of government data, we have the ISM, we have ADP, we have Indeed.
Paul, I just figured it out. Constance Hunter's going with Diane Swank to the Michigan State game up in East Lansing. That's what this is. Good to know.
Good to know. Constance, I mean, again, I'm just looking at the CPI data today. I'm just not seeing this tariff-induced inflation here. It seems like maybe the companies are just kind of taking it in the P&L, and we are not going to see tariff-induced inflation.
Well, I don't think that means we're never going to see it. On the other hand, I mean, I guess there is the possibility that firms find ways to be efficient and absorb these tariff costs, but it seems somewhat unlikely. And firms, if you survey them, have said they want to pass on tariff price increases. But it's really challenging when you think of what a K-shaped economy we are in, right? That top 10% of consumers, of wage earners, are also those that own equities and are participating in this bull market. Whereas the bottom part of that K, we're starting to see increased delinquencies with credit cards and auto loans. Those are levels that we saw coming out of the global financial crisis. And that indicates that segment of the market is really struggling.
So where will we see that? Will we see that in consumer spending? Will we see that in retail sales? Where do you think we'll see that?
Well, we're not going to see it in retail sales because it's not inflation adjusted. So if anything, we might see retail sales go up a bit. But I think we'll see it in the inflation adjusted consumer spending numbers. Households are going to have to pull back. And the other thing is, while it's not in this report, the anticipation is that we're going to see upward pressure on utilities like electricity, which is going to curb the ability of households to spend in other areas.
Labor market here. That's another mandate of this Federal Reserve. The headline numbers look fine, but I know there are definitely some concerns underneath the hood there. How do you think about the U.S. labor market?
Well, the labor market is weakening because we're seeing a declining breadth that we have seen for some time now. I'm talking about the August data. Of course, we don't have that September data. And then if we look at, again, alternative indicators, so if you look at the ISM employment indicator, that's been a very good, especially on services, a very good predictor of overall jobs growth. And that also is weak. And then we're seeing a pullback in state and local hiring. Those state and local municipalities received huge windfall money from the rise in real estate prices, and they were hiring a deficit of workers that they didn't hire coming out of the global financial crisis.
Constance, quickly here, does a president deserve to be impatient with the Fed?
Well, it depends on what you think the Fed's job is, right? If you think the Fed's job is to move fast, break things, be anticipatory, behave like a hedge fund, I suppose, yes. But by design, the Fed is supposed to be a little late to react. Because if they react preemptively and they're wrong, there's much more downside risk than if they're fashionably late, but still in the right direction.
I like that, fashionably late.
Yes.
Constance, thank you so much. Constance Hunter coming to us through the Economic Intelligence Unit today on this inflation. To review here, our quiescent report, futures up 22, they double. Futures up 41, up 0.6%. NASDAQ 100 futures up 1%, now up 0.9% as well. The VIX solidly under 17. Wow. 16.64. Speaking, well, let's do this first. Bloomberg surveillance. I'm so out of practice with our data, Paul.
I know.
It's a shock to have data. He is at the height of fashion at all time. It's good to catch up and get a framework for the weekend with Kit Juckes. He's head of foreign exchange strategy at Societe Generale. Kit, just cut to the chase. What are you going to write about for Monday within the geopolitics that you see, the litmus paper of the foreign exchange system? What's your theme to get to Monday morning?
Going into Monday morning, I suspect it's going to be the resilience of this strong dollar, in all honesty. Even just looking now over my shoulder at what's going on since the release of a soft CPI print, the market is not, it's going to price in some rate cuts from the Fed with more enthusiasm at the margin than before. We don't know much more than we did, but we'll price a little bit more enthusiastically on easing. And I'm not seeing the dollar backing off very much at all on that. Because and it's sorry.
No, continue, please.
I was going to say, because the CPI numbers don't tell us anything new about growth, and that's where the real debate about the U.S. economy is going to happen.
What you're so good at, Kit, is there a bet in the market right now?
I think the market's betting on rate cuts, but it's also betting on resilient growth. That keeps me confused. And I should add, this is the most dollar-centric, U.S.-centric economic cycle that I can remember in ages, because the uncertainty around the U.S. GDP numbers, retail sales numbers, consumer price numbers is much bigger than the uncertainty about the lack of growth in Europe or in Asia. So it's all about you guys. And we're getting no information. So when we get some, we think the labor market's weakening, but not knowing more, we're I think collectively assuming that we shouldn't be revising down GDP forecasts. So that there's lots of productivity, there's lots of AI, there's lots of good things. The equity market's still strong. So U.S. exceptionalism is still in place. That bet is there. Today's soft CPI prints will encourage rate cuts, but they won't change that optimism about the economy, is my bet.
And Kit, it's interesting for me at least to hear you say it's still all about the U.S. exceptionalism, because the trade has been that it's kind of about you guys over in Europe. I mean, you're starting to spend some money on defense and your infrastructure, and you can't really depend upon the U.S. to the extent that you did before. How do you think about that dynamic? Because we do have the euro again out at 116 here.
Well, the euro popped up to 116 on a move down in U.S. rate expectations that narrowed the gap significantly, and on some optimism in growth. Obviously, the fiscal problems in France haven't helped on that.
That's true.
And equally, that there's not a huge amount of there's hope. But if we look at the exceptional spending that the Germans were getting ready to unleash, it's not happening fast enough. So you see the real performers in Europe are the people that can be more fleet of foot. The Swedish krona has been doing very well because they have a bigger arms industry relative to their economy, but they also are pushing forwards. The Norwegian krona is doing really well. The euro is lagging those, and the Swiss franc is doing as well as the euro is.
Yeah.
speaks volumes about safe havens.
That's right where I wanted to go. Audrey Child-Friedman with Bloomberg at Queen Victoria Street. Kit was just brilliant yesterday on analyzing Swiss franc. I mean, I guess it's out of the purview of many of our listeners and viewers. Explain the ramifications for America, for Zurich, for Geneva, if the Swiss franc breaks to new strength.
I think it causes, I think people will then turn around and see much more clearly that there's money chasing havens, that the money that we see enthusiastically going to gold, because we quite like that story, that actually this is a world where people want to put their money somewhere safe in a vault deep underneath the Alps. That's not animal spirits in the sense that we know and understand them. So it tells people that although the U.S. economy is dominant, people aren't really confident in the dollar.
Yeah.
And they're not confident in the euro, and they're not confident in the yen. And hey, presto, we don't mind if the rates are zero. We're coming to Switzerland.
Kit Juckes, thanks for the brief. Way too short. Kit Juckes with Societe Generale. Let us know, Kit, when you're in New York City next time. Honored to have you in the studio. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Michael Darda joins from Roth Capital here, steeped in Wisconsin economics. Michael, I'm just going to cut to the chase. Everyone's head's spinning, and yet we just got a disinflationary vector all in all. Like we got real GDP wrong and nominal GDP wrong this year. Are we getting massively wrong the need for the Fed to cut, where they're going to have to pick it up?
Well, that is yet to be seen, Tom. I think the Fed is a little bit on a preset course here, at least for the next two meetings, and then we'll see what happens to this big divergence between the labor market data, which has been exceptionally weak, in the activity indicators. Looks like Q3 probably ended on a pretty strong note with underlying, real growth pretty close to 3%.
Unbelievable.
And, not nominal, up in the fives. That is not a picture of an economy that needs a lot of monetary support. Yet the labor market indicators that the Fed is watching have been weak, and so there's a bit of a divergence and puzzle that I think needs to be solved there.
Tom, Michael is a native of Wisconsin. He did graduate from the University of Wisconsin at Whitewater, but he lives in Naples, Florida. He bailed on those Wisconsin winters so quickly.
He's got like 8 residents.
Yeah. I see these Wisconsin people that, they bail, they go to Florida.
The transportation of the dogs keeps United and Delta and chips.
Hey, Michael, so we're not, I guess if you just look at the CPI print today, we're not seeing any real tariff-induced inflation in this economy. Does that surprise you?
Well, we definitely saw a lift, mostly in goods prices over the course of the last few months, and that may be easing back now. But I will say this, the bond market does not look like it's really concerned about inflation. The bond yields have fallen from a high of 4.8% early in the year. We're just a touch below 4 now. Inflation expectations in the bond market have been coming down. That's a forward-looking measure. And so I think a lot of the tariff-oriented upward pressure on inflation is, likely to be quite temporary. And that's exactly what forward-looking markets are saying. I'll also throw this out. There's a private sector group called Trueflation. The data is on the Bloomberg terminal, and they update daily in terms of year-over-year inflation readings, and it's a much broader swath of prices. The CPI is based on about 90,000 prices. The Trueflation index, which is blockchain-based, is driven by 15 million or so prices, and that's pretty close to 2%. And historically, it doesn't typically undershoot overall CPI inflation. So there's not an obvious downward bias there. It's just higher frequency, and it's measuring a much broader swath of prices. And this kind of a divergence is exactly what you'd expect with a one-time relative price shock from the tariffs. It's very different from a monetary inflation. And so that definitely gives the Fed a bit more room to maneuver here to try to support the labor market.
Trueflation. Tom, I've worked here at Bloomberg for 16 years. This Michael Darda guy just taught me a Bloomberg function I didn't even know existed.
The history here, we've got to get to the market open here, but I really want to express the originality of what young Darda did years ago. He worked for Jude Wieniawski, who was legendary. He was like 18 years old. And then he went over, and all of a sudden there were these research reports melding the market and economics. And the only reason we talked to him is he used Bloomberg terminal screens.
Boom.
And it was like Ed Hyman.
This is my new go-to.
People were like stealing research from Darda over the years, now at Roth Capital. Michael, I think I want to focus on the equity markets here. It's Friday, and I'm going to get my angst of gloom crew rationalizing this is going to end. What's your treatment, speaking of Jude Wieniawski, of the history of great bull markets? How do they end?
Well, Tom, if you want some efficient markets hypothesis and theory here, the bull market will end when the profits expansion ends. So typically bear markets are clustered around recessionary periods. But how's this for a statistic? 90% of the time post-World War II, the economy is in an expansion phase, not a contraction phase. And the equity market tends to go up about 75% of the time. So the default position should be more optimistic than pessimistic. All of that said, people are nervous because the valuations are quite high, concentrated in infotech and the AI-driven story. But that's not going to be enough to cause the market to crack here. I really think you'd need to have the earnings story evaporate. Q3 earnings have been pretty good so far, high single digits. It looks like we're probably going to end up double digits year over year for earnings growth. So as long as that support structures under the equity market, I think we'll probably hold on to most of these gains.
Michael, what's your view of the U.S. labor market here? The headline numbers seem pretty more than fine, more than good, but I know there are some concerns under the hood.
Yeah, there are some concerns, Paul. The ADP figures that we have through September showed actual job declines in 3 out of the last 4 months. That's not typically something that you would see in a healthy economy. Yet the activity indicators I mentioned, GDP tracking and so forth, still look pretty strong. There's a Dallas Fed index that is weekly, that's scaled to year-to-year GDP growth, and that's still running up, above 2%. And so I think what could end up happening here is that as we move into next year, we'll see some of these jobs figures improve. I think the tariff and uncertainty shock caused employers to pull back. But if the top line growth is still there, the profitability story is still intact, then pretty unlikely that you would see the labor market completely fall out of bed. And that is something, Tom asked about the Fed and if the easing expectations were too aggressive. If we do start to see a better tone and tenor to the employment data, the market will have to reprice the reality of the easing cycle that, is now pretty aggressive.
Michael Darda, thank you so much. With Roth Capital, really appreciate it. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Leslie Palti-Guzman right now, founder at Vista Energy. She's been absolutely fabulous about the larger politics of it. Just as a Friday question, maybe the president meets with President Xi. Is China energy independent? They really rely on oil coming through Singapore, right?
Yes, but China wants maybe one day to become independent. They are producing a lot of hydrocarbons right now. I mean, they're producing their own coal. They are becoming one of the largest natural gas producer. The amount of gas they are producing now is about almost the same as the whole African continent. Wow. But they are still importing. They are still importers. And their strategy has been also to create links and relationship between all those suppliers.
My head is spinning this morning with your geography. Which geography are you most interested in, what you're writing about for Monday?
My focus has always been global, as you can hear with my accent. I was born and raised, educated in France, so Europe, I know it. But I've been based in the US for 20 years now, and I've been focusing a lot on Asia, also the US, maritime routes. So very global, but my sectorial is, expertise is energy, commodities, geopolitics.
Yeah. It's not a job interview.
Yes.
What you write, Ed Moore says there's lots of boats on the water.
Yes.
That everything's floating around right now. Is that true?
There are many boats, yeah. Is
there a glut of oil in the marketplace these days?
So we have the same question on the gas side too.
Okay.
There are, we are awash with oil and gas potentially. But the key question for countries is how to get it just on time in a safe manner, diversification of routes, prices, and I think we need more OECD countries exporting their supply.
Where in reality does the Russia gas and oil go? And can that be curbed, or is there always going to be a way for those hydrocarbons to find their way to a buyer?
Yeah, that's a great question, because actually this week we've seen a ramping up of sanctions on the European side and on the US side. In Europe, the European Union has agreed on phasing out Russian gas and Russian LNG by the 1st of January 2026 with a 2-year transition period. So they will start first potentially with LNG and then pipeline gas. Right now, there is almost the share of Russian gas in Europe, we used to be 45%, is down to, a trivial amount, and 0% in 2028. Real. And so it means that in Europe it's going to be possible with a cost potentially. So Europe is going to be more dependent on other suppliers, like the mix has really changed. More Norwegian gas, more US LNG into Europe.
Nice. Russian hydrocarbons, are they going to go to India? Are they going to go to China? Because that's kind of where I think we
absolutely. We've seen a reconfiguration of trade flows. The gas from Russia, especially the sanctioned gas, is going to China. Like the LNG cargoes from Arctic 2, only China has been taking it.
Thank you. The sanction thing, and I'm not up to speed on this. Hugh Van Steenis was brilliant yesterday on this. Leslie, how does India and Modi fit into successful sanctions? If Modi doesn't play with Trump, it doesn't work, right?
Yeah. So yesterday was all about the oil sanctions. And it's going to be a matter, if they are successful, it's going to be a matter of enforcement and whether the US alliances are strong enough. Will Modi still take Lukoil or Rosneft oil right now after yesterday's sanction? I'm not sure. Will China still take it? Probably, maybe. I think strong allies from the US will not dare taking this oil anymore.
Interesting. So, but with Brent crude at $66 a barrel, the global energy complex can't be very happy these days. Don't they need oil $75, $80, $85 a barrel?
So it depends who you're talking to. If you're a producer...
exactly. That's what I'm thinking about. My friends in Texas and Oklahoma, not to mention the folks at OPEC.
Yes. It's a fine balance for the Trump administration. You want the right equilibrium price, the same for Saudi Arabia. They want the right price for their economy. In the U.S., we're lucky because the U.S. has abundant oil and gas. The producers need to see return on their investments. What is going to be interesting to see on the gas side is whether we're going to start producing more on the dry gas, which is less dependent from the oil price. So just the fields that are producing only gas, not associated oil. And in this case, they are less dependent from the oil price.
So gas, I thought natural gas came out of oil wells and fracking and all that kind of stuff. But there are separate sources of natural gas?
Civil engineering with Paul.
Yeah, exactly. We're diving deep into this now.
So I'm talking mostly about shale gas, right, in the US. And you have shale oil too. Some of it, depending on the basin in the US, you get both shale oil and shale gas. And then when you're moving to different basins, you have only dry gas, what we call dry gas.
That's a new one for me.
And it's only gas.
In 10 years, is the United States of America energy independent? 10 years out, 15 years out?
So it depends the definition of energy independent. But right now, the US is the largest oil and gas producer exporter globally.
Yeah. See? Okay. And that just happened like 2016. Up until like that, we were energy importers.
Correct.
And then thanks to the whole fracking technology, we're now net exporters, right?
Yeah.
That's awesome.
Thank you for this brief. To have Ed Morrison from Hartree and to have Leslie Palti-Guzman, and this has really been a wonderful week in hydrocarbons.
And Tom, you got to watch Landman, and then you'll be all in on oil and gas.
I'm watching Slow Horses. That's where my head is right now.
All right.
Yeah, one of my kids said, "You look like Jackson Lamb." I said, "Well, thank you." But I'll watch Landman. Is it?
Yes. Yes, you're going to love it.
Okay.
It's all about the energy.
Leslie Palti-Guzman, thank you so much. Vista Energy, really, really appreciate it. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We cut to the chase. Joining us now for Without Question, our AI conversation of the day, Jeffrey Schumacher, Ernst & Winnie, Ernst & Young, EY Growth Platforms leader at EY-Parthenon. You are in the depths of this. And what I love about what you do, it's not about stupid chatbots and tech boys with $8 latte. It's about what are companies going to do? What is Target going to do with your neurosymbolic AI approach?
Oh, look at that. Nailed it.
Nailed it. That's good. NSAI. Yeah. So Tom, like what we have is a growth platform, right? So it takes enterprise data, it unifies it with other external sources, and it allows predictions around growth that enterprises and CEOs such as Target and Cornell back in the day can bank their business on.
Are they? The audience is scared stiff about this. How many jobs are going to go? Do you guys have at EY-Parthenon? Do you have a sum? What's going to do to the unemployment rate, et cetera?
I think you got to look at the two sides of the medallion, right? There's one side around productivity where Gen AI is there. Yeah. The other side is growth. That's where neurosymbolic plays. The growth is where you're going to activate a lot of jobs, right? So if you have both sides, I think you might lose some on the productivity, but you're going to replace it on the growth. Okay, so
Target's coming out with this headline. Do you see buried in that they're quietly going to do, what do you call it, Paul, synergies?
Yeah.
At Duke, they call it synergies.
Yep.
They're doing synergies, but they're going to hire people on the other side of it?
I think you'll see the evolution of jobs to where these growth opportunities lie, and corporations that embrace the neurosymbolic side of this equation favors first movers.
Did I do okay on that?
That was pretty good.
That was all Carol Massar. Carol Massar briefed me all last night.
I know. All right, I think most of our listeners and viewers have some grasp of what AI is. It's an evolutionary thing we're still learning. What is neurosymbolic AI?
Yeah, so if you look at the analysts, they'll tell you it's about 2 to 5 years away. We have it today. The neuro side of it is the unification of data to understand behavior. The symbolic side are the rules to which you look at that behavior.
And how do companies use that?
So it focuses on their commercial model. Said another way for your listeners, how they make money.
Okay.
So how they price, how they forecast, how they enter a market, how they create a new product, new service, how they buy something or divest.
But don't those companies hire lots of MBAs to figure out how to price a product, how to market a product, how to account for that product?
Yes, and just like in pricing, you'll have MBAs that do regression models, but you regression, which is how you figure out what is the right price, right? So are you pricing for margin or are you pricing for growth? Neurosymbolic can take, well, what market are you in? Who are your competitive sets? What if the products don't line up? All of those things, which that tree of reasoning grows, right? And neurosymbolic allows you to apply all of that and grab margin that you otherwise wouldn't get. We had one business, we created $8 million in EBIT on a $50 million business.
And how many jobs exited in that example?
It's more how many jobs created in that example.
On a net basis, jobs are created.
Jobs are created on a net basis.
I mean, I'm going to be honest, folks. I'm in that camp, which is this is all going to end up. I said this at the CFA soiree last night at the Luzetti building. I'm sorry. I'm in the camp where this is going to be net positive. X% of my audience totally disagrees with what I said, Jeff. Speak to the people scared stiff that 14.2% of every company's jobs are going to walk out the door.
Yeah, so if you look at productivity, Tom, I agree with you. There are things that you're going to do faster and more. Now, if you're just doing that, you're going to reduction in jobs on that side. But on the other side, you're going to create jobs. I'll give you another one. An example, a manufacturer, big equipment manufacturer.
John Deere.
Good example, very similar.
It's the only one I know, so go with it. John Deere. What's it called? Neurosymbolic. The Red Sox need neurosymbolic AI. What is neurosymbolic AI going to do to Peoria, Illinois?
I love that, John. So if you take John Deere, you can take telemetrics data, and you can take their financing data when they sell a machine, and you can apply that to OSHA data coming from the government. And guess what I can do for John Deere? Well, they finance all their products. Well, now I can create insurance on the bottom side or the back side of that. So they have a better, taking in telemetrics data, the machine data, the OSHA data from the government telling you site, location, construction, and then the financing data, I can build a better underwriting model than an insurance company. I just created a whole new revenue line for John Deere, a whole set of new employees for John Deere, and a whole changing their margin mix and revenue mix of their business, which if you change your margin profile, you change your EBITDA profile, you change your multiple, therefore your market capitalization. Right there, Tom, I just probably added 30% to the market cap of John Deere.
Nice. Well, I'm just convinced that the first 3 or 4 years of my investment banking career can be completely replaced by AI. I mean, all I did is make pitch books and proofread prospectuses, and that can all be done. When you go to the board of a company, I'm sure the board's asking, what's this return I should be getting on all these investments I've been making on AI over the last 2 or 3 years? How do you kind of frame that out for them, the return on AI investments?
Well, I think you got to understand there's two sides to that medallion. One side is productivity. There's your Gen AI and your agentic, and the other side is growth. There's neurosymbolic. So when you look at those two, you're going to have your productivity gains, which means you're going to be able to write emails faster. You're going to be able to do call center scripts faster. You're going to be able to do all of those things faster. Neurosymbolic is going to give you the precision to understand where the value is in market. And what we've seen with neurosymbolic in the companies that we're working with using it, it favors dramatically first movers. And Tom, to your example, you're going to go play Moneyball. And you're going to, when everybody else is buying players, you're buying wins, and you're buying wins by buying runs, and you're buying runs by getting on base. And if you build that, you'll build a team for a fraction of the dollars. And in 2003, you win more games than anybody else in the American League.
This sounds like a Brewers fan. So what I would say. Okay, you mentioned medallion twice. Yes. If I get an EY-Parthenon medallion, can I convince Afterthought to empty the dishwasher this weekend? I mean, what's a medallion?
Well, it's not a medallion. It's just an example of the way to think about it. If you want to branch it into two, use MECE, another business term, mutually exclusive, collectively exhaustive. One side is productivity, Gen AI. The other side is growth and neurosymbolic.
Should we have them back, Lisa? What do you think? I mean,
my head is blown. Yes.
Jeff Schumacher, a successful visit. And you know what would be scary? Schumacher and Greg Dacco together.
Oh, yeah.
Ooh. That would be like scary. Like the economics tied into the neurosymbolic AI.
The mathematics.
This is brilliant. Jeff Schumacher, thank you so much. Out of Eau Claire, Wisconsin, and with Ernst & Young Parthenon.
This is the Bloomberg Surveillance Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.